For more on real estate, let's bring in Marty Burger, Silverstein Properties CEO. Marty, it's great to have you on the show. Thanks for being here.
Thanks, Morgan.
So when I think about Silverstein Properties, I think about this extensive portfolio you have of office space, residential, retail space, but then you also have this capital partners, this real estate lending arm as well. And we just talked about a little bit about commercial real estate. We did see this Moody's downgrade today on the banks talking about commercial real estate as a rising risk for some of those entities. What are you seeing right now across the company in terms of activity and in terms of health of the sector more broadly?
Well, it's a challenging time, obviously. Interest rates are up, so it puts pressure on all of our cash flows. The residential markets are doing extremely well, and so we're taking advantage of that. The office market, the leasing is slow, mostly because companies just don't know what to do with their space because they're all coming back and figuring out what their population is and how they're going to use their space. And other property types like hotel and retail have been recovering. But again, this upward pressure of the interest rates is just challenging us all.
Yeah, I mean, I guess how much further does this correction have to go? We've been talking about it on CNBC, this $1.5 trillion in loan maturities that are going to come due over the next, let's call it, 3 years. How does this dynamic play out? Do we even know yet? How does it compare to previous cycles?
Well, it's a tough situation because you'll have a lot of loans mature in the next 3 years, and when you go to try to refinance those loans, the interest rate coverage won't be there, and so there's going to be a mismatch between valuation and the maturing mortgages, and that's why we're seeing all this pressure on the banking industry.
Yeah, and I guess, are you seeing that in some of your own properties right now, or is there a greater opportunity in terms of that mismatch for you to be able to go out and make more acquisitions right now and engage in more developments?
We've had a couple assets where we had to be proactive and take care of that, and for the most part, we've done that. And we certainly want to take advantage of this dynamic going forward, whether it's buying older office buildings and converting them to retail, to residential, or buying other distressed assets with good prices.
Yeah, you did just make an acquisition, 55 Broad Street, which is right down the street from where you're joining me right now in Manhattan's financial district. Is there an expectation, and I realize there's rezoning efforts afoot in Midtown Manhattan as well, do you expect that we're going to see more of this office space, given the structural shift in office space usage and vacancy rates right now in general, that we're going to see it converted to residential?
You'd certainly expect it. However, it's not the easiest thing to get done. You have to worry about, as you said, zoning, floor plate sizes, the age of the building and how the mechanical systems work. But you will see a lot of it.
Okay. We did talk about this Moody's downgrade on some of the banks. We've seen the regional banks in particular experiencing some issues and rethinking their portfolios right now. Is that an opportunity for Silverstein to step in and extend loans? I guess, how are you thinking about that mix in terms of credit moving forward?
I mean, to the extent that the Fed or the SEC is telling banks to work with good borrowers, that obviously helps us if we have a troubled asset. Most of our assets aren't troubled, but as time goes on and more of our mortgages mature, if interest rates don't come back down, it may become an asset. It may become a problem because we'll have trouble refinancing it. And so you're seeing that, especially in the regional banks, which have such a heavy real estate presence. And so the maturities that come up, they'll have issues with all their loans.
Yeah. Final question for you. I mean, I think about Silverstein. I think about the World Trade Center. What are you seeing in terms of some of that higher quality, newer office space? I mean, is there a bifurcation in the market in general right now?
There certainly is. Even in the Class A properties, there's a big difference between Class A and brand new Class A. When you see buildings like One Vanderbilt or 425 Park get rents upwards of $250 a foot, there's certainly a flight to quality. And when people are trying to keep their employees in the office, you want to have the best space possible and the highest technology space you can get.
Can we say that we've found the new normal in terms of how office space is being used and the dynamics with work from home? Has it normalized yet?
I don't think so. I think people are still trying to figure it out. I think companies are bringing back their employees and learning about how they're using this space. And I think we've got at least another year to go before people really feel confident about how the future of office is going to be used.